forward with the MMA Mondays. That's the macro analytics that we cover. And this week it was Pepe and myself also covering the GMX token. So to start off with, I'll quickly share my screen. There we go. So the comparison for MMA was done more so with looking at how DYOR and GMX compare and sort of other competitors in the market. So if we look at DYDX as an example, we can see on screen, this is the exchange. They have tons and tons of different tokens that you can trade on their exchange. And then when we look at GMX, so on the Arbitrum chain, we have the option for ETH, Bitcoin, Link, and Uniswap. And if we move across to the Avalanche chain, it's pretty similar, but we have AVAX, ETH, Bitcoin, and Wrapped Bitcoin. Now, with that said, what's really interesting is even with that difference where we have so many more options on DYDX, the actual TVL, the actual amount of numbers, if we look at it, so we have around 630 million on GMX and only 350 million on DYDX. So this is some analytics from DeFi Llama. And we can see as a comparison with the gray being DYDX, it seems to have had a big jump. It stayed steady towards the beginning of 22, and then it's pretty much had a slow decline. Whereas looking at GMX, it's had a steady upwards increase in the protocol use and the TVL, and it's now sustaining at quite a significant level all throughout 2023. So it just goes to show that even if you do offer so much more, sometimes quality is better than quantity. And another thing we found as well, directly comparing the two, on Token Terminal, there's a leaderboard for the earnings. Looking at it over the last year, we can see GMX around 10th position and 13th is DYDX. So what do we see here? So we're looking at all the fees that are paid out on an annual basis. We're looking at the revenue, which is the fees generated for token holders. We've got the incentives, so that's those that are distributed out. And then the earnings basically is just the difference between how much revenue versus the token incentive. So anything that's positive is profit, I guess. So we can see here the numbers for all the other big chains. But what we do see is GMX is quite a bit in profit there, 10 million, where DYDX is 21 million. So we can see a lot more numbers being used and spent, but not that much being kept there as well. So that's very, very interesting numbers there indeed. So yeah, so that's just more of a comparison for some of the analytics. Pepe, what do you think?
No, I mean, the breakdown that you just gave is excellent. And I think that that's really the point of analyzing it in terms of a market competitor analysis in the business sense. As an investor, it's always that's really the difference between investing and trading, in my opinion, is at the investing side, which is where I'm more of I lean towards, less so than the trading side. Is that on the investment side, it's really important to understand, revenue, profit, fees in DeFi, stuff like that, and how are they generating this money, and then which platforms are better to capitalize on in that sense, right? So obviously, DYDX, according to Token Terminal, the earnings are negative by 21 million versus GMX is up 10 million. You know what I mean? And like you said, that in relation to the uptrend for GMX versus the downtrend for DYDX, there's factors for that.
Yeah.
And we can get into that, a little more in depth. And we did get into that much more in depth in a report that will eventually be published on our website. I think that just overall, GMX is a very bullish platform in the macro, since that's what we're talking about. Keeping an eye on these perp futures exchanges that are decentralized and have anonymous founders, or pseudonymous at least. It's going to be a big moneymaker in the future when we have these issues with centralized exchanges, right? U.S. investors, we're not supposed to be using these perp exchanges, but I mean, everybody knows that in the space, people are using these exchanges. So that's a massive use case. Whereas DYDX is it's founded in the United States, and it can be used all over the world except the U.S. So it's a big hindrance there to taking market share, and that might be also why there's a significant or at least a noticeable decline in DYDX. They do have some bullish news, and I think we're going to run DYDX next week, so we'll get into that in terms of development on the protocol and stuff like that. But will it actually be able to compete with protocols like GMX? In my opinion, I don't think so. I think GMX is super bullish. Yeah, we see the price volatility as of late, and TA isn't looking too good. But if you look at the tokenomics, which I'm sure the other guys will get into in a bit, it's pretty bullish in my opinion, and that's why I'm personally staking over there. It's a owning part of a casino that never goes wrong unless the casino goes under. So
yeah, pretty much, and that's where we can see so much revenue is given out, and they're still in profit as well. So it's essentially a win-win for everyone. Whereas, as you can see here with things like Ethereum and those of others, there are so many that are making a loss, and it's not like everyone's winning. So that having that shared prosperity is really good, and that's what really means. That's what sustainability really means, doesn't it? Whereas if you're just giving away
100%.
money, how do you ensure that you're there for the long term?
Exactly. And I mean, even so just compare it with, look at the earnings of Uniswap compared to GMX of all things. And Uniswap is no joke. You know what I mean? They have $500 million in fees in the last year. So it's a serious protocol, but the tokenomics have
150K out of that.
Right.
That's
right.
insane. As a
Yeah. And you see the difference there with GMX. I mean, it's like, massive difference in terms of, the fees that are generated and then the percentage that's paid out for the incentives. So, yeah, I don't know. I mean, I'm a little biased, and I want to state that because I'm holding some GMX, but I'm holding it for the reasons that I stated, and I think it's important, not only in this case, but in all cases. And that's what we try to do with our research, is try to give everybody a good idea in terms of analysis and how to really be a smart investor and pay attention to all the things that make a good protocol worth investing in.
Awesome. Yeah, I think that pretty much covers most of the report. Like Pepe said, we've got more in the actual report itself, and there will be a more in-depth version for the website and for the articles as well. Looking forward, are there any questions from anyone on this one? Cool. So what I'll do is I'll also bring up looking at, WWF is the Wallet Wednesday findings, and the Token Audit Thursday, they also were covering the GMX as well. So bringing you guys up, we'll have that discussion about individually what was going on, as well as how the MMA, WWF, and Token Audit Thursdays all linking together. So the starting off with the WWF, that was something that Sloth and I were working on. So Sloth, do you want to cover on what we found on the Wallet Wednesday findings?
Yeah, definitely go over that. Let me go ahead and share my screen real quick. Okay, so first thing we'll look at is the actual GMX dashboard, which shows the analytics. So this is strictly looking at the Arbitrum chain, since the majority of the volume is on there. So we can see total volume's at 113 billion currently. I think total, if you look at the total volume, it's about 135 billion. So that's including the Avalanche and Arbitrum. So that's all-time volume for GMX, right? And then looking at the GLP pool, got 533 billion, and we just see just continuous increase in both the volume and the fees being generated on here. And then also the total amount of users is just hit over 500,000. And then if we look at the
I think
this
that was
is
a
a
quarter
pretty,
million.
or yeah, sorry, I haven't had enough coffee today. Sorry,
Yeah.
quarter million. We'll probably hit a 500,000 this time next year for sure if things keep
Yeah.
progressing. Anyway, but here, this is a good one to take a look at, is that the trader's profit versus loss, right? So we could see, I mean, currently, the the profit is a little bit more than the loss, even though the cumulative is a little bit more towards the loss side of things. But overall, I mean, um, the profit side of things is usually leaning more towards profit as opposed to loss. And then a few other things we can look at here is, so the total pool for the vault pool for GMX has just been continuously increasing. I mean, look at just, this time last year we were at was it about 20 just under 300 million, about 280 million, and now we're, up above 600 million. So, just a 2x increase within the past year. And then also we can see, so currently, if we look at the current open interest, it's leaning more towards the long. So there's about 3 times more open long interest than the short positions currently. And then few other things we can look at is the total amount staked. Currently, we're at a 382 million, which is a little over 80% of the total market cap, which is pretty insane. And then some other metrics too. If we look here, so this is looking at the Arbitrum network. Just kind of see the comparison for the price action and the market cap and volume. So I can see it kind of on a slightly steady increase since the Bitcoin bear market rally. And then here, so we see the total supply of GMX versus the amount of holders. So you see there was a bit of a increase in the total supply being unlocked, and then just continuous increase in the amount of holders as well. And then here is the supply distribution, which is pretty cool to look at. So you can see how many addresses are holding, what amount of coins. So I mean, if we see here, there's really only, a little less than 30 wallets that are holding more than 10,000 coins, which is good. If we look at the distribution, that means there's not really a ton of whales, controlling like a huge amount of the supply. So that's another good thing. Consider, shows more even distribution, and which is a good thing to look at when we're looking at the tokenomics. And then some other good info here too. If we look at Nansen, comparing, so this is looking at the Avalanche chain. We see the, weekly trades per DEX. I mean, this is, just going off of the Trader Joe and Pangolin DEX. So, we can see the difference here as opposed to if we switch over to the Arbitrum chain. I mean, there's, at least 10 times the amount of trades happening on Arbitrum as opposed to Avalanche, just, because of the usage of the Ethereum network. So we see this huge spike with the Uniswap exchange.
Yeah, and it's
And then
interesting
again,
because looking at that comparison there,
yeah.
the AVAX, the difference between starting on AVAX and Arbitrum was launched only 4 or 5 months later, and yet the difference is so much more. So it shows that they
Yeah,
made a good decision to go on and expand onto that network, and it's really increased their overall value.
yeah, exactly. And then we can see a few more metrics here for the token distribution, which is nice. So we see the token balances, so done pretty steady increase. As far as the balance on the DEXs, it's been, steady above 80% as opposed to the centralized exchanges. And then we don't really see a ton of we don't really see a huge amount as far as like smart money or funds holding the tokens, which is good to see. as opposed to if we take a look here at the Avalanche network. So it's a little bit different. So we actually see kind of the opposite almost. So we see, steady decrease in the DEXs versus the centralized exchanges. So it just kind of points to, more people are moving to using GMX on Arbitrum as opposed to Avalanche. And that could be, just like the fees are typically a little less on Arbitrum versus AVAX, and then just the ease of use, and also I think just because people generally just prefer ETH over other platforms just for the security and longevity of the platform. And then here we see the amount of unique addresses over time. So this is again looking at the Avalanche chain. So we see pretty steady increase. And then if you look here at the Arbitrum network, it's obviously way more. And we see here that it kind of started around the August of last year, right? It was kind of hanging around, like 5-digit addresses, and then just massive, huge spike up since then, and it's just been increasing nonstop. And now sitting at almost 300,000 addresses for the token just on Arbitrum alone, which is pretty insane. So yeah, some nice increase in usage, and then also good distribution between the whale wallets, which is nice to see. And then we can also see, so here's the actual transactions. So this is comparing whale wallet transactions for transactions with over $100,000 worth of GMX, and then $1 million worth of GMX. So if we cut this off and just look at specifically the transactions above $1 million, it's pretty well spread out. We see, one every maybe couple or a few weeks, and then it's a little bit more prominent with the slightly smaller balances. And then here, this is just some social metrics that we can see. So this is just purely looking at Twitter followers over time. So we see here, beginning of the year, right, we're at about 96,000, and then up until now, so 6 months later, it's pretty much doubled as far as their Twitter following, which is pretty crazy given we're supposedly in a bear market. Okay, and I think that's pretty much covers everything. I don't know if there's anything else you wanted to go over, G.
Yeah, I'm just going to share my screen quickly as well. So just looking at the comparison of fees directly on the GMX site. So we have stats for both Arbitrum and for AVAX. Let me share my screen 1 and go. So we can see on the left-hand side is the Arbitrum side, and we've got the AVAX on the right. So just the considerable difference. We've got 450 million and 900 million under management. So almost, that's over double. 70 million in the pool for GOP, 500 million there. We've got 5 million over the 24-hour volume, and what's considerable here is 175. So it's considerable difference. But we've got the 19 million, we've got 130 there, we've got 18 million in long, we've got 90 million in long, and under 1 for the short, but almost 40 for there as well. So, and then the considerable and the most recent, it being the 200 million in fees compared to the 200,000, sorry, and then the 1.5 million. So again, if we're looking at how much revenue is made in terms of the pools, how much fees are distributed to people as well, it's a lot more profitable to be on the Arbitrum network as well. So
Yeah.
for those of you who would have been there a little bit earlier, would have also profited from the Arbitrum airdrop just by taking part in things like this as well. So some great stuff and great analytics as a comparison. But yeah, I think that's it from the Whale Wallet Wednesday thing. Unless anyone else has anything to add before we move to Token Audit Thursday.
Yeah, just real quick. I don't know if they're going to cover it in Token Audit Thursday, but one thing if you're so always read the docs before you start to use a platform, because I didn't know why. Sometimes when you have a trigger order in, because the trigger orders are how you put in a take profit and stop loss on GMX versus exchanges. It's slightly different. They actually have like an input. I mean, it's basically the same thing, but they have an input for stop loss and trigger order, or I'm sorry, stop loss and profit. And with GMX, what happens is because it's completely run by smart contracts, what you have to do is you have to put in the order, and then like you open the position, and then you have to go manually put in the trigger order for the stop loss and the take profit on both sides. And then if you manually close out of the trade prior to the stop loss or trigger order, or I'm sorry, stop loss or take profit order going through, you have to close those orders because they'll just remain. So there's a few reasons why the trade will not close with a trigger order. And so like no keeper picked up the order, specified price was not reached, or it was reached, but not long enough for it to be to be executed. So you can't really get. I mean, you can get wicked out if the wick stays long enough. I don't know what that duration is. I can't find it in the docs, but just from using the platform, it actually is kind of nice because you can't really get like if you get wicked out on the liquidation or it would hit your stop loss and it's just quick, it won't close the order. You know what I mean? So you can kind of mitigate any of these, price manipulations and stuff like that might happen. But on the other side, it also won't close your profit. So I actually watched that happen one time, and I had to manually close when it was on the wick, and then it executed the order because I manually ran it through. But that, and also the price on GMX is an aggregate of exchanges. So say you're looking at like the Binance chart for Bitcoin on TradingView. It's actually better to do it on GMX because they actually have TradingView integrated into their platform. So you're going to get more close to the price that's aggregated across exchanges versus just looking at like one exchange and then you wonder why it didn't close when it hit on Binance, but maybe it didn't hit across the markets that are being aggregated with the Oracle. So just wanted to point that out.
Cool. Yeah, some great features there. It's interesting that wick feature to not get stopped out. So Trill, both yourself and Sloth worked on the token, GMX token, and its viability. How did your report come along?
As far as the audit side, I'll actually touch on a couple of points that were already mentioned, especially as far as Pepe's most recent point is like getting wicked out. The reason why people get wicked out just in conventional trading is because trading is mostly done via order book trading, and with order books, you put in a buy, and the on the opposite end there's someone else basically on the opposite of your trade, and that's how the trade gets facilitated or completed. GMX works differently because it uses the automated market maker systems, kind of like some other decentralized finance protocols. And the price, also to touch on the point that Pepe stated, the price is aggregated from something called Chainlink oracles, and Chainlink oracles is just a feature of, say, cryptocurrency in which they take real-time events across, any type of event. It could be even weather, gaming, and things like that, and that can be integrated into a smart contract to provide functionality. So, you like GMX, the pricing comes from the Chainlink oracles. Like Chainlink oracles are used pretty commonly, and actually a lot of ETH or a lot of pools in general, they get their token prices, or like the ETH, or not, I keep saying ETH, but the cryptocurrency to USD price via the Chainlink oracles. I'll show my screen as far as like looking at GMX from a investment standpoint, like things you would want to look at. All right, so we look at the total entire crypto global market cap. I mean, it's over 1 trillion, and looked at it was stated earlier, but it was somewhere here. But yeah, GMX's total market cap is 440 million. So out of that 1 trillion, GMX has 440 million of the market cap. And then if you wanted to see what is the potential for GMX, you could look at the categories that it is competing, or it is making a presence in, and you kind of want to see that that market cap. So out of the decentralized finance market cap, uh, I mean 47 billion, and GMX is only 400 million. So how you'd want to look at GMX is just like out of like what is the potential for GMX to capitalize on the entire decentralized finance market cap. I mean, it's kind of be crazy to expect for it to take over this entire market cap, but if I'm doing the math correctly, I believe it should. I believe it only has maybe 1% of this entire market cap. So, if GMX had about, just 10% of the entire decentralized finance market cap, obviously that would catapult the token price a lot higher. And just looking at it from its current point, because even now it's actually a little bit higher than its the most recent low from the all-time high. Because looking at it from a broader standpoint, the overall all-time high, is around 90, and its current price is a little over 50. So about around 40% off from the highs currently, even though most of the cryptocurrencies are about 80% off their high. So it's just like something in the note as far as GMX. The team is working on a new, let's say, a new functionality to the protocol that would actually uh, kind of like it would allow developers to actually develop tokens and things like that on the protocol. It's a little iffy as to what it will be exactly. Because if you actually do want to try and find out now, this was actually removed, but this is I retrieved it via a web archive. Like as we know with the internet, all things are on the internet forever. So this was snapshotted at one point while it was on there. As you see with the date, but this doesn't exist anymore. The people who posted it, so it's likely they're working on reworking exactly how this is going to be. But with X4, it's just going to give the people who create the pools more control over how those pools function and things like that. Um, so the fees, and then also giving allowing people to create tokens and things like that within GMX. So as far as how GMX, that two-tier token, the two-tier structure works, we have the governance token, utility token that accrues some fee token, which is basically like a stock market index. But with this token, you also have direct access actually, to the tokens that are being represented within this index. And you can, actually swap between, this token and the represented tokens within the index, respected to the current value against whichever which way you're swapping. And that's pretty much about it. All I have to cover on GMX, unless Slav says any other thing.
Yeah, I mean, I think you pretty much covered it. I mean, as far as the actual token goes, I mean, best thing to understand is, the actual GMX token is the governance staking. So there's what's called ES GMX, which can be staked for rewards and vested over a year, which become GMX tokens. And then there's also the GLP, which is the liquidity provider token as well, which people can stake and then cruise 70% of the platform fees for LP rewards. But yeah, other than that, I think pretty much everything was covered.
Cool. Thank you for that. Are there any questions in the chat for us before we go? Christine, do you want to jump on?
Just real quickly before Christine goes, I just
Yep.
want to point out that GMX is a basically controlled inflation. So there's essentially a max supply of 13.25 million GMX. And then there's the capability in the contract to mint beyond that, controlled by a 28-day time lock. But that can only happen with a governance vote, and only if there's more products launched and liquidity mining is a required element as well.
Yep.
And I'm glad you're up here on the stage, Pepe, because I wasn't actually sure who to direct this question to, but it was the one thing that I was kind of curious about that wasn't covered, because you guys knocked it out of the park today with all the information. I'm curious, with the rising popularity of the GMX forks that are happening, I guess I kind of curious what feedback you guys might have. Is that a good thing? Is that a bad thing? Would it need, I guess, further exploitation?
Yeah, for sure. I think, G, can you pull up your screen? Because I forget what link it is there, but I can explain while you're pulling it up. The analytics on Nansen, I think, that show the breakdown of these GMX forks. In my opinion, they're not worth it. The reason why is there's such a low market cap, and the problem with that is that crypto people love low market caps on one of them, right? Because you can make massive gains. But the problem is with the utility of a perpetual futures decentralized platform is that the platform is not going to be usable if there's not enough liquidity to trade on the platform, because that's the whole fundamental purpose of the protocol, right? So if you don't have the deep liquidity that Arbitrum has or AVAX has, I've seen multiple times where you can't open a position because the liquidity is dried up from that pool, and you will only have access to the available liquidity in that specific trading pair, right? So if you have, okay, oh wow, it's 9 million market cap. I can make a lot of money with this. It's not really, because this is one of the times where use case definitely matters in crypto, right? Where it's if they don't have the liquidity to offer traders, the traders are going to go somewhere else where they can get that liquidity. You know what I mean? So yeah, I mean, that's a big fundamental risk factor, I would say. And in my opinion, I would say they're not worth it. I mean, we can look here. Yeah, so G found it. Nice. You can see, I mean, so we have can you scroll up, G? Sorry. We can look at, so across all the forks, TVL is 40 million, all of them. And there's 30, upwards of 30 or something like that, maybe more.
34.
34, yeah. So there's 34 platforms. You can see some of them are already rugged, and the top one only has 8 million TVL. It's not very deep liquidity for traders to use. You know what I mean? So I mean, right now alone on AVAX, on GMX, there's 18 million open in long positions and almost 1 million open in short positions. You see what I mean? Like, and then they only have 8.7 million on this quick perks. You know, the other thing is too, is like, in the business sense, like, all they're doing is they just forked it and then they put it on another chain or whatever they did. And probably some of them are on the same chain, but they're trying to like hype it up. So like, is there really a business use case? You're gonna try to steal market share from GMX based on what? You know what I mean? It doesn't make any sense to me at all. So
No, the only reason for these is mostly just a quick flip. It's a quick cash liquidity grab. That's really all it is most of the
Yeah.
time. I mean,
100%. Yeah.
you might get lucky and might get to flip the coin for quick profit. If you can get in early enough. But other than that, it's not really worth the risk, in my opinion.
Yeah.
Yeah, I know
Cool.
some people are always like on it when forks happen, and it seems like, with this explanation, I can totally see what you guys mean. Kind of more in detail on how, it's very high risk.
Yep.
Yeah, 100%. And it's always about
Cool.
managing that risk, as an investor. So don't get emotional and be like, oh man, this might be something one day. I don't want to miss out. It's like, that might work with a coin that doesn't have any utility, but these tokens have to have utility. You know what I mean? In order to make a viable flip, yeah, you can make a lot with meme coins, but again, there's no utility there. So it's like the risk with a meme coin, in my opinion, is less than the risk with these GMX forks.
Yeah, and then typically with the meme coins, like the utility is usually built after the fact, right? After it's already launched, and then
Exactly.
maybe you'll pick the one that goes berserk, like SHIB or Pepe, one of those.
Right.
Yeah, you wouldn't want to invest into a service that doesn't actually have a service running yet. So, or a profitable, not necessarily profitable, because sometimes it takes a little time to become profitable, but just just an efficient or usable service that people would actually aggregate or come to use.
Yeah, exactly.
Great review, guys, this week. You guys dropped loads of information this week on this. I liked it. Thank you so much.